On Monday morning, $250 billion evaporated from Nvidia's market value in a single trading session. Not over a bad earnings report, not because of a product recall or a scandal. About a machine most people have never heard of. Built by a company most people have never heard of, doing a job most people don't fully understand. By the closing bell, ASML, the Dutch company that has quietly controlled one of the most important choke points in the entire global technology supply chain for decades, had lost more than 55 billion euros in value. Samsung and SK Hynix, two of the biggest memory chip makers on the planet, each fell more than 13%. South Korea's entire stock market briefly halted trading after plunging nearly 11%. AMD dropped more than 8%. Micron fell close to 6%. This wasn't a bad day for one company. This was a genuine across-the-board panic that rippled through the entire global semiconductor industry within hours. So, what actually happened? China just started producing, in small numbers. Arguably the single most important piece of equipment in modern chipmaking. The kind of machine that, until very recently, only one company on Earth could reliably build. Why ASML dominates the chip industry? To understand why this news triggered a genuine market panic, instead of a shrug, you need to understand just how uniquely powerful ASML's position in the chip industry has been. Every advanced computer chip, from the processor in your phone to the AI accelerators powering the biggest data centers on the planet, starts as a blank silicon wafer that needs incredibly precise patterns etched onto it. Patterns measured in nanometers, a scale genuinely difficult to fully wrap your head around. The machines that do this etching, called lithography systems, are some of the most sophisticated pieces of industrial equipment ever built, combining precision optics, laser systems, and mechanical engineering into devices that can cost well over $100 million each. For decades, one company, ASML, based in the Netherlands, has held an almost total monopoly on the most advanced versions of this equipment, not a dominant market share, not the leading player among several competitors, but an actual functional monopoly on the machines capable of producing the world's most cutting-edge chips. Every major chipmaker on the planet, whether TSMC in Taiwan, Samsung in South Korea, or Intel in the United States, has depended entirely on ASML for the equipment needed to manufacture their most advanced products. What China actually built, that kind of concentrated control over a single critical choke point, is exactly why lithography equipment has become one of the central battlegrounds in the broader technology competition between the United States and China. Export restrictions have specifically targeted ASML's most advanced machines, blocking their sale to Chinese chipmakers for years, precisely because controlling access to this one company's equipment has proven one of the most effective tools available for slowing China's ability to manufacture its own cutting-edge chips domestically. Here's what changed. On July 27th, reporting emerged that a state-backed consortium based in Shanghai, tied to Huawei-affiliated equipment maker Sicarier, had begun low-volume production of its own immersion lithography machines, specifically in the DUV, or deep ultraviolet category of equipment. The company at the center of this, Shanghai Yuliangsheng Technology, was founded in 2022 with roughly 1 billion yuan in registered capital and has spent the years since quietly working toward this moment. According to the reporting, the plan is to produce roughly 5 of these machines in 2026, scaling toward approximately 20 units in 2027, with initial customers expected to include SMIC, Huaheng, and CXMT, 3 of China's most important domestic chipmakers. It's important to be precise about exactly what kind of breakthrough this is, because the framing matters. Enormously, this is not an EUV machine. The even more advanced category of lithography equipment that ASML alone produces and that remains completely restricted from export to China under current controls. This is a DUV immersion machine, a somewhat less advanced category of equipment, but one still genuinely capable of producing meaningfully advanced chips, just not the absolute cutting-edge EUV machines enable. Even so, the significance is real. Producing a functional, immersion-capable DUV lithography machine domestically, without relying on ASML at all, represents a genuine technical achievement, one Chinese equipment makers have been working toward for years without previously demonstrating this level of actual production capability. That's exactly why the market reacted the way it did, even though, as we'll get into, there are real reasons for caution about how much this changes in the near term. The day the market panicked, let's walk through what actually happened in the markets, because the scale of the reaction tells its own story about how sensitive this particular choke point has become. ASML shares fell more than 8%, hitting their lowest point since early June, dropping to around $165.90. That single-day move wiped out roughly 55 billion euros in market value from a company that, until that morning, held one of the most secure competitive positions in the entire technology industry. Nvidia, despite having no direct connection to ASML's lithography business, fell about 5%, erasing approximately $250 billion in a single trading session as investors reassessed the broader competitive landscape for the chip supply chain. Nvidia depends on. The reaction spread well beyond those two companies. AMD dropped more than 8%. Micron, the last remaining major American memory chip manufacturer, fell close to 6%. Samsung and SK Hynix each fell more than 13% in a single session. SanDisk dropped roughly 11%, and South Korea's benchmark Kospi index fell nearly 11% at one point, triggering an automatic trading halt designed specifically to prevent panic-driven crashes from spiraling further out of control. That's an extraordinary amount of value destroyed across an entire industry, triggered by news about a relatively small number of machines that, by the company's own stated targets, won't reach meaningful production volume until 2027. The scale of that reaction tells you something important on its own. Investors weren't just pricing in the 5 machines coming this year. They were pricing in the psychological and strategic shock of ASML's monopoly showing its first genuine crack, and trying to work out what that means. For the next 5 to 10 years of competitive positioning across the entire chip industry, the reality check here's where it's worth slowing down for the honest, complete picture. Because a lot of the coverage of this story leaned hard into the dramatic market reaction, without spending enough time on what serious industry analysts are actually saying about the near-term reality. Semiconductor analysis firm, SemiAnalysis, along with CNBC and Reuters Breaking Views, have all published pieces since this news broke, specifically urging caution about how much this actually changes in the short term. The numbers make the gap clear on their own. ASML currently ships somewhere around 130 immersion lithography machines annually, representing years of refined manufacturing processes, deep customer relationships, and proven reliability at massive scale. China's new domestic effort is targeting 5 machines this year, climbing to perhaps 20 next year, not remotely close to competing with ASML's actual production volume, even setting aside questions of technical performance entirely, and performance is exactly where the bigger question marks remain. Analysts specifically flag concerns around yield, meaning the percentage of chips coming out of the manufacturing process that actually meet quality standards. Throughput, meaning how many wafers the machine can process per hour, and overall reliability. These are exactly the areas where ASML's decades of accumulated engineering experience show up most clearly, and they're notoriously difficult to fully replicate quickly, even once the basic underlying technology has been demonstrated to work at all. Reuters Breaking Views specifically characterized the near-term competitive threat to ASML as, in their words, overdone, suggesting that market's dramatic single-day reaction significantly overshot the actual near-term business impact of this specific announcement. That's a genuinely important caveat worth taking seriously rather than getting why the market reacted this strongly anyway. So, if the near-term impact really is this limited, why did the market react with such genuine panic? This is worth understanding because it says a lot about how these kinds of strategic technology stories actually move markets. Markets don't just price in what's true today, they price in trajectories and psychological shifts in how a competitive landscape is perceived going forward. For years, ASML's monopoly on advanced lithography equipment has been treated by investors as something close to an unbreakable moat, a genuinely unique competitive advantage justifying premium valuations across the entire chip equipment sector. The moment credible evidence emerged that this moat had its first real crack, even a small one, even limited to a less advanced category of equipment, investors immediately began reassessing what the next 5 to 10 years might realistically look like, rather than just reacting to this year's actual production numbers. That kind of re-rating where a stock's valuation shifts because the market's assumptions about a company's long-term competitive position have changed. Tends to produce exactly this kind of outsized single-day reaction disproportionate to the immediate current year. Business impact. It's less about the 5 machines shipping this year and more about what it might mean. If that number becomes 50 machines in 3 years or 500 in 6, following a trajectory similar to how China's other manufacturing sectors have scaled once the initial technical barrier was cracked. That pattern, a slow initial breakthrough followed by rapid scaling once the fundamental technology is proven, has shown up repeatedly across other Chinese manufacturing sectors, from solar panels to batteries to shipbuilding. Investors reacting to this lithography news aren't necessarily wrong to think about that pattern. They're making a bet about trajectory, not just reading this year's production targets, literally. Whether that bet proves accurate for lithography equipment specifically, given how much harder this technology is to scale compared to those other sectors, remains a genuinely open question. What this means for the broader chip race? Step back, and this story fits a larger pattern. China responding to Western technology restrictions, not by giving up, but by finding an adjacent path forward, even an imperfect one, rather than waiting for a full parity before making any move at all. Blocked from purchasing ASML's most advanced EUV machines and facing tightening restrictions on even some categories of DUV equipment, China's response has been to invest heavily in developing its own domestic lithography capability, starting with the less advanced but still meaningfully useful DUV category first. That's a genuinely sensible strategic sequencing, rather than attempting to leap directly to matching ASML's most cutting-edge EUV technology, a considerably harder engineering challenge. Chinese equipment makers are building manufacturing experience and production capability at the DUV level first, which still supports a meaningful, if not the most advanced, tier of chip production. This also connects to the packaging and chiplet strategies covered in earlier discussions of this topic. If China can produce enough of these somewhat less advanced chips domestically, then combine them using advanced packaging techniques like glass substrate technology, it opens a viable path toward competitive AI hardware performance that doesn't require matching ASML's most advanced equipment at all, at least not in the near term. It's a multi-front strategy: lithography, packaging, and materials innovation, all advancing somewhat independently, but ultimately reinforcing each other toward the same overall goal of reducing dependency on equipment the West controls. Whether this specific lithography breakthrough ends up mattering enormously, or turns out to be a much smaller step than Monday's dramatic market reaction implied, will become clearer over the next year or two, as it becomes evident whether Shanghai Yuliangsheng can actually hit its stated production targets and whether chips coming off these domestically produced machines meet the yield and reliability standards real commercial chip production requires. Who else is racing toward this goal? It's worth understanding that Shanghai Yuliangsheng isn't operating in isolation. China's push toward domestic lithography capability has been building across multiple companies and research institutions. Simultaneously, with this specific announcement representing the most visible, most commercially advanced result to emerge publicly so far, Huawei's connection to this effort through its affiliated equipment maker, Secarrier, is particularly significant. Given the company's broader role in China's technology self-sufficiency push over the past several years, Huawei has already demonstrated genuine ability to develop advanced chip design capability domestically, most notably with its own AI accelerator chips. Despite years of increasingly severe export restrictions specifically targeting its access to Western semiconductor technology, that track record matters. Here, because it suggests a company with real demonstrated experience navigating around technology restrictions through sustained, well-funded internal development, rather than simply hoping restrictions would eventually be lifted. Beyond Huawei's ecosystem, several Chinese universities and state research institutions have published academic papers over the past few years describing progress on various lithography subcomponents, from precision optics to laser light sources to the extremely sensitive positioning systems required to align a wafer with nanometer-level precision during exposure. Much of this research has moved slowly and quietly, without generating the kind of dramatic headline this specific commercial announcement produced, but it represents the broader foundation of accumulated technical knowledge that made a moment like this possible in the first place. Genuine industrial breakthroughs like this one rarely emerge from a single company working in complete isolation. They tend to emerge from an entire ecosystem of research institutions, component suppliers, and manufacturers advancing in parallel, occasionally converging into a single publicly visible milestone that captures everyone's attention at once, the way this announcement clearly has. This broader ecosystem view also helps explain why serious industry analysts, while cautious about near-term production numbers, aren't simply dismissing this as an isolated, unsustainable achievement. A single successful machine from a single company might reasonably be dismissed as an outlier. A machine emerging from a well-funded, Huawei-connected consortium built on years of parallel academic and industrial research. Across multiple institutions reads as something considerably more structurally significant, even while the specific near-term production and yield numbers remain genuinely limited compared to ASML's established scale. The export control response to watch for. There's an important second-order question worth considering here. One, extending beyond simply whether China's machines work well enough to compete commercially. How might this development influence future export control policy decisions in Washington and Brussels? Export restrictions on lithography equipment have historically been calibrated around a specific strategic logic, restricting access to the most advanced tools, while sometimes allowing sales of somewhat less advanced equipment, on the theory that maintaining some level of commercial relationship serves broader diplomatic and economic interests. While truly cutting-edge technology remains fully restricted, a credible domestic Chinese alternative at the DUV level, even an imperfect one, could meaningfully shift that calculation. If Chinese chipmakers increasingly have a viable, if less advanced, domestic option for DUV equipment specifically, the traditional argument for maintaining even limited commercial access to that tier of Western equipment as a point of ongoing leverage becomes considerably weaker. This could plausibly cut in either direction, and it's genuinely difficult to predict with confidence which way policymakers will lean. One argument suggests restrictions on remaining categories of Western equipment could actually tighten further. On the theory that once China demonstrates independent capability at one tier, policymakers may become more willing to fully restrict everything else, since the diplomatic cost of that restriction no longer carries the same commercial leverage benefit it once did when China remained fully dependent. The opposing argument suggests the reverse, that policymakers might recognize restrictions are increasingly ineffective at actually preventing Chinese domestic development, simply accelerating it instead, and therefore ease certain restrictions rather than continuing to incentivize exactly the kind of urgent, well-funded domestic development effort that produced this breakthrough in the first place. Whichever direction policy actually moves, this announcement will likely factor into discussions in Washington, Brussels, and Tokyo over the coming months, precisely because it represents concrete, verifiable evidence about how effective current restrictions have actually been at slowing China's semiconductor equipment development. Rather than remaining a purely theoretical debate about hypothetical future capability, what this means for the US and China. Here's the honest read. After digging through both the dramatic headlines and the more sober analyst commentary that followed, the market's reaction on Monday genuinely overshot the actual near-term business impact of this specific news. 5 machines this year, scaling to 20 next year, against roughly 130 annual shipments, simply isn't a business-threatening near-term competitive shift. And the serious yield and reliability questions analysts have raised are legitimate, not dismissive corporate spin from a threatened incumbent. At the same time, it isn't right to dismiss this as meaningless either. This is a genuine technical milestone, the kind of proof-of-concept moment that has historically preceded much faster scaling in other Chinese manufacturing sectors, once the fundamental technology gets demonstrated to actually work in production. What's most interesting about this story is how clearly it illustrates the gap between market psychology and near-term business reality. Both things can be true simultaneously. The immediate business impact on ASML this year is genuinely limited, and the strategic significance of ASML's monopoly, showing its first real crack, is genuinely important for how this entire industry gets valued and thought about over the coming decade. Monday's stock reaction is best read as a signal about shifting long-term expectations, not an accurate read on this year's actual competitive landscape. And the next 12 to 18 months of actual production data will tell far more than one dramatic trading session possibly could. The future of semiconductor manufacturing, there's a broader lesson here too, worth keeping in mind for every future headline in this space. Markets, and honestly a lot of news coverage generally, tend to compress complicated multi-year technology trajectories into single dramatic moments. A stock crash, a product launch, a surprising quarterly earnings report. The reality of how semiconductor manufacturing capability actually develops is almost always slower, messier, and more gradual than any single headline. Reaction genuinely does reflect a real shift in how investors are pricing long-term risk across this entire sector. But treating any single day's stock movement as the definitive verdict on a technology race this complex, this capital-intensive, and this dependent on sustained execution over years rather than months is almost always a mistake. The honest answer to how significant this breakthrough ultimately turns out to be is going to take considerably longer than one trading session to reveal itself.